Hello and welcome to Star USA Training. Today is Tuesday, July 8th, and we're excited to be talking with Travis Smith and Meredith Lambert of TRG about cargo insurance. Whether you're joining us live or watching the recording back, we appreciate you being here. If you're attending live, we encourage you to introduce yourself in the chat and let us know where you're joining us from today. We also invite you to connect with Star USA on LinkedIn. We are focused on growing our presence this year by sharing valuable content, including our industry insights, updates, articles, and other training opportunities, and by partnering with companies such as TRG. We would love to connect with you, and if you're comfortable, feel free to drop your LinkedIn profile in the chat as well so we can continue with the conversation beyond today's session. This session is being recorded. After the webinar, we will upload the recording, the slides, and any additional materials to our website. If you register for the webinar, you will get an email with the link once all of those things have become available on the website. This session qualifies for 1 CE credit for licensed customs brokers and those with CCS or CES designation through NCBFAA. Please be sure to save the code given at the end of the session. If you are watching this back on YouTube later, it will be a different code for the recorded session, so keep that in mind. We do encourage you to stay engaged throughout today's session. If you have questions, drop them in the Q&A at any time. We've set aside time at the end to address as many of those as possible. Quick disclaimer, today's discussion is informational only and should not be considered legal advice or the transaction of customs business on your behalf. If you or your company need additional assistance after the webinar, please don't hesitate to reach out to STAR or to TRG directly. And I'll do some quick introductions here as we get started. My name is Michael Easton. I am the President and General Manager of Star USA. STAR is an international trade and compliance consulting firm. We provide consulting and managed service solutions for companies that are navigating international business, particularly in regulatory trade compliance. I have over 20 years in the industry, and I've been lucky enough to work with and meet folks like the ones that that have agreed to be our guest speakers for this event. So it's my pleasure to introduce Travis Smith and Meredith Lambert from Trade Risk Guaranty. STAR has worked with TRG for many years, helping our clients secure bonds, cargo insurance, and otherwise navigate some of the essential parts of being a responsible global business. Travis and Meredith have been in the industry long enough to remember when ISF was brand new and have been navigating all of the changes and challenges along the way since then. Meredith's experience stems from translating U.S. customs regulations and insurance jargon into easily digestible content. And Travis spends his time on the phone speaking directly with individuals that oversee cargo insurance and the U.S. Customs bond. And with that, I will turn it over to Travis, who will begin sharing his screen. And just a reminder that please use the Q&A and the chat functions, and we will be happy to get to your stuff throughout the webinar.
Thanks, Michael. Thanks for that introduction, and thanks for everybody for taking the time to be here. We're all very busy. There's a lot going on. So let's jump right into it. I mean, this webinar is branded "What the heck is cargo insurance and who needs it?" We're going to talk about cargo insurance. We're going to talk about how tariffs impact cargo insurance. And given the opportunity to talk in front of a group of companies that ship internationally, we also have to talk the U.S. Customs bond a bit. Given tariffs, there's a lot to stay ahead of there with the customs bonds. We're going to go over cargo insurance and the customs import bond. With that, just a quick introduction of TRG. Many of you may be familiar with TRG. We might have some clients on this webinar, but think of us as an insurance agency that deals exclusively with companies that ship internationally. So if you import, export, we can be a service provider for you. We write U.S. customs bonds. On the customs bond side, of course, we have claims assistance. We do have a compliance software available to all of our bond clients. And we'll dive into that for just a couple of quick slides so you see that capability and decide if you think it'd be helpful for your company. We have a specific anti-dumping and countervailing bond program that we really like to highlight. We like working with anti-dumping countervailing companies. But of course, you know, the run-of-the-mill everyday importer is the bulk of our clients. And we write, of course, cargo insurance. We'll talk a lot about cargo insurance today. So let's jump right into it. The basics of marine cargo insurance. What the heck is marine cargo insurance? So think of it like, so marine cargo insurance is property insurance. And the most relatable example is think of it as your car insurance, your auto insurance. If your car is lost, stolen, or damaged, then you file a a claim with your car provider, your car insurance provider. Same thing with cargo insurance. If your cargo is lost, stolen, or damaged, or involved in a general average event, then cargo insurance can help your company through that claim and through that loss to protect you against too much financial burden. To expand on that, cargo insurance covers more than ocean shipments. So marine cargo insurance, that name is a bit misleading. It might make you believe that it only covers the goods while they're on the water. But as over the decades and the hundreds of years since marine cargo insurance has been in place, the coverage has been expanded to cover all modes of transportation. So marine cargo insurance can include the drayage to and from ports. It can include domestic trucking. It can include Canada to Mexico trucking, air freight, rail, any mode of transportation. I suppose in the next 2 years or so, we're going to start talking about goods being transported via drone. That's not a topic we're going to cover today, but it's something we're going to be talking about in the future. So it covers any mode of transportation, and it can cover your entire supply chain. So what does your supply chain include? It might include international shipments. It might include domestic, so the shipments that begin and end within the same country. It can absolutely include warehouses, whether it's a warehouse you own or a third-party warehouse. That's part of your supply chain. So a marine cargo insurance policy can include the international shipment, domestic shipments, the warehousing, so your goods while they sit in a warehouse, whether it's owned by you or by a third party. Marine cargo insurance can even include manufacturing or processing or packaging. So when you throw in that manufacturing or processing or packaging, generally the agency will call it a stock throughput policy. And, it's kind of a fancy term, but again, that processing, that manufacturing can be considered part of your supply chain. So we can include that on these marine cargo policies. And when you're looking at annual coverage, there are really 3 types of coverage that the policy starts with. The first, and by far and away the most common, is Institute Cargo Clause A. This is 98% of TRG's cargo insurance clients are written on an Institute Cargo Clause A policy. ICCA is also known as all risk. So it's the broadest form of coverage. And we'll talk about that more here in a minute. There's also Institute Cargo Clause B, which is more restrictive coverage. It only covers what is listed. Instead of the policy starting as all risk, like Institute Cargo Clause A, it only covers what is specifically listed. And then the most restrictive is Institute Cargo Clause C, which again only covers what is listed, and it covers the fewest amount of events. Why would you ever want Institute Cargo Clause B or C? A good example is scrap metal. If you ship scrap metal, it really can't be scratched or dented or damaged, but it can sink to the bottom of the ocean. It can catch on fire and be damaged or chemically changed through a fire, or maybe through theft. Or those are examples where you don't need the full coverage of Institute Cargo Clause A. You don't want to pay the extra for all of that coverage, but you absolutely do want coverage for a complete loss, which is a good example where you might go with Institute Cargo Clause B or C. So looking deeper at Institute Cargo Clause A, the most common, most broad cover that you're going to get in cargo insurance. Remember, the policy starts by simply saying it covers everything. There are exclusions that are commonly written in. Now, this is kind of boilerplate. You go to any insurance company, they're going to exclude these events. Can there be exceptions? Can there be tweaks? Absolutely. But these are the exclusions you'll most commonly see. Improper packaging. Now, the packaging has to kind of be grossly improper for it not to be covered. Or if there's a pattern of improper packaging leading to claims, you're going to get pushback on a claim due to improper packaging. So generally speaking, improper packaging is excluded. Abandonment of cargo. If the insured on the policy just abandons the cargo, that's not going to be covered. Rejection by the government. If the goods get turned around at the port and sent back to where they came from, or not allowed into the U.S., that's not generally not covered. You used to be able to get that covered more often years and years ago. Sometimes we still see policies where rejection by the government can be written in as covered, but it's something you really have to negotiate with the insurance company with, and make sure you make it a talking point if it's important to your company. Failure to pay or collect, that's not covered. Inherent vice is not covered. And with inherent vice, think of bananas. If you ship bananas all over the world and you have a container of bananas that you know is going to spoil in 4 weeks, but you also know the shipment is going to take 5 weeks, and the bananas arrive at their destination and they're spoiled and they're bad and they can't be sold, you cannot file a cargo insurance claim for that. No insurance company is going to pay out on that. It's not the bananas going bad are not a result of a fortuitous event. It's just what happened. So you got to be careful with inherent vice. Cargo insurance is not going to cover inherent vice. Delay. If the goods are not lost, stolen, or damaged, and they're just sitting in the water waiting for a port strike to be resolved, there's no claim to be had because the goods are just delayed. They're not lost, stolen, or damaged. Cargo insurance is not going to cover the loss or use of a market. So if the end buyer decides not to buy the goods, cargo insurance will not cover that. Nuclear incident, there's an exclusion for nuclear incidents. So hopefully that never comes into play in our world, but that is an exclusion. Loss over the policy limit. We're going to be talking more about policy limit in a bit, but every cargo insurance policy has a limit, the most they'll pay out on any one single claim. So you got to make sure your limit on your policy is high enough. Losses outside the policy warehouse to warehouse clause. Now, if you have an annual policy and the terms are warehouse to warehouse, so door from the supplier to door of the delivery, and the loss occurs outside of that transit, it's not going to be covered. But keep in mind, you can absolutely expand your policy to include parts of the supply chain in addition to warehouse. So if your policy is exclusive warehouse to warehouse and it's only going to cover during that transit, but you can include domestic, you can include warehouse coverage, so you can expand the coverage. Ocean barge shipments generally excluded unless you ask for the coverage. Goods subject to on-deck bill of lading generally excluded unless you ask for the coverage. War, strikes, riots, and civil commotions. All TRG policies, and generally speaking, any annual provider for cargo insurance, it's kind of weird. They initially exclude war, strikes, riots, and civil commotions, but it's standard to write that coverage back in. So it's excluded, then it's written in as covered. And if you ever read your policy, you will see that as covered. Cyber-related events. This is a big deal. I really want to highlight this. There's a lot of cyber-related events going on, and cargo insurance policies do not cover cyber-related events. I've seen one market that does cover cyber-related events, but they really box it in and keep the limit very, very small. So they're able to say they cover cyber-related events, but in practice, the limit is very low and the coverage is very restricted. The best way to cover cyber-related events is to have a standalone cyber policies through a specialty agency, and make sure you talk to that agent to say, hey, I ship internationally. If my goods are on an ocean vessel and somebody hacks the controls of that ocean vessel and runs that vessel aground, or hacks into the ocean vessel and steals the goods. That sounds crazy, but we're going to see that happen eventually. That's a cyber-related event. Cargo insurance policies exclude cyber events, so you'll want that covered on a standalone cyber liability policy. If you have any more questions about cyber liability policies, just ask me. Find me on LinkedIn or email me, and I can direct you to an agent that really specializes in cyber liability.
Travis, we had one
Michael?
a question in the chat about whether or not the war risk might cover the Houthi attacks and on cargo ships.
Yeah, it totally could. I mean, if you're subject to that and it's involved. Now you got to be careful with that. I mean, if you're commonly shipping through that part of the world, your underwriters might be excluding or they might require you to disclose those shipments to make sure coverage applies. So it's getting trickier and trickier to talk about this type of stuff. You got the events happening in Ukraine, and we're seeing many insurance companies exclude that region of the world or say, if you want coverage for that, talk to us first. So my advice for anybody that's shipping through regions of the world that are subject to these events is to talk to your agent and get confirmation from the insurance company that they'll cover if something happens. Not the most straightforward answer in the world, but a lot of the answers do loop back around to talking to the actual insurance company that underwrites the policy. Cool. So ways to purchase coverage. The last one listed, an annual policy. That's what we just talked. That's what we've been talking about primarily. That's what TRG sells. We write annual all risk policies, and we will write Institute Cargo Clause B or Institute Cargo Clause C if the circumstances require that. But those are all examples of annual policies. The other options to secure coverage, the first listed right there is shipment by shipment insurance. So if you only ship once or twice a year, your best option to insure is going to be to pay the freight company that is moving your goods for per shipment insurance. So they will just include on the invoice a line item for insurance. If you ship in aggregate more than $200,000 worth of goods a year, then likely an annual policy will cost less than per shipment insurance. Will cost less than shipment by shipment. So if you ship less than $200,000 worth of goods in aggregate throughout the year and you want insurance, shipment by shipment is probably the best way to go. If you ship more than $200,000 worth of goods throughout the year, then an annual policy is probably going to be the most cost effective and best coverage you're going to get. The other alternative is CIF coverage. So if you're buying goods on the CIF Incoterm, then the supplier overseas is required to include insurance to the destination point. So if you're buying goods from a Chinese supplier on CIF Incoterms, that Chinese supplier is required to provide insurance to the U.S. port. The coverage stops at the U.S. port. So in this example, you have a lapse in coverage between the port and the door of delivery. Also with CIF coverage, per the Incoterm, the supplier is only required to secure minimum insurance. What's minimum insurance? I don't know. It gets really dicey. Also, if you have a claim, you're going to call your supplier and say, hey, the goods arrived damaged. They're going to give you contact information for an insurance agency in their country 9 times out of 10. So CIF insurance, I think it's mega risky. I don't like it. I mean, I sell annual policies, so I'm biased. But unless you have CIF agreement with maybe a parent company or a sister company or your uncle in Italy, I would be really weary of CIF coverage. Carrier limit of liability. So I talk to companies that ship internationally and they say, yeah, Travis, if something goes wrong, the shipping line or the trucking company is going to pay. And that's mega risky. Maybe that's the worst assumption to be under. Carriers, the companies that move the goods, either the shipping line or the trucking company or the airline, they are legally required to carry liability insurance. It is not property insurance. They're legally required to carry it to cover their butt in the event that they're liable for the event. What is covered? Only losses due to their negligence. What is not covered? Acts of God, fire, interference by public enemy of the United States, war, strikes, riots, civil commotion, outright excluded, improper packaging, government action like road closures, quarantines. I mean, the list is kind of hard to read, But the big thing to remember is unless you are purchasing your own cargo insurance, acts of God is not going to be covered. And then if there is a claim and you do have to rely on the carrier's limited liability to try and recoup some money, you have to prove that the carrier was negligent. Unless the carrier was grossly negligent and they know there's no way out of it, then they'll just pay. A little bit more on the carrier limited liability. If the carrier does pay out in the event of a loss, they're not going to pay out based on the value of the shipment. They're going to use a schedule of tariffs based on the weight of the goods. So you're not going to get paid out in full. If you have an annual policy in place, then you'll work with the insurance agent that provides that annual policy. You'll get paid out through the agency, and on the back end, the insurance company will go to the carrier to pull any money out of them that they possibly can. So relying on the carrier to pay you out in the event of a claim is very risky, and you're not going to end up happy in the event of a claim. The claims process. Let's talk about that a bit. People always have questions about this. How long does it take to settle a claim? In a perfect world, I'd be able to stand up here and say, hey, we pay out everybody within 2 weeks. I can't say that at all. That's not realistic. That's not the way the world works. Generally, within 30 days, you got to think about the complexity of the claim. There's different categories, and each category has their own details about the circumstances of the claim, the size of the claim. If it's a claim of less than $10,000, generally speaking, it's going to be a quicker turnaround. If it's more than $10,000, then the insurance company is going to, they're going to dig in further, and it's probably going to take longer than 30 days. There's no set answer to this question. It just depends on so many details, but it boils around to the agency that you're securing the coverage from. I'm going to say, I think if you ship internationally and you want to rely on your cargo insurance, you want to make sure you work with an agency that talks a talk and walks a walk, an agency that will be able to represent you to the insurance company to make sure your claim is moving along, to make sure you're presenting your information as wrapped up as possible. Those details will help the claims process. You're never going to love a claims process. Nobody does, but you do want to be working with an agency that knows cargo insurance and is going to be able to kind of hold your hand through the process. But the general steps of filing a claim: number one, notification. If you think there might be a claim, loop in your agent as soon as possible. A good agency will help identify if they need to notify the insurance company. And generally speaking, the longer time between the actual claim and when the insurance company is notified, the more weary the insurance company is going to be of the claim, the more difficult it's going to be to get the claim settled. So if you think there might be a claim, notify your insurance company and start there. Of course, there's information gathering. When I look at the claims through TRG, really the information we request is pretty basic. We got to justify the value of the claim, pictures if it's a damage situation, but it's pretty basic information. Determination, you got to give the insurance company time to go through their processes to make sure they're doing everything proper. That's a general outline of how the claims work. So comparing a claims process, in this example, we have the carrier limited liability versus an all risk policy through TRG. With carrier limited liability, you must file the claim within 9 months of delivery. That's a huge window. If you wait for 8 months to file a claim, it's going to be a total nightmare. Delivery receipt has to be included in the notice of damage. So the delivery receipt, when the truck arrives and one of your employees signs for the goods, if they just sign and they don't say, where they sign, they don't say package looks mishandled or package has been damaged, that's going to make it very, very difficult to file that claim. Proof of value and loss is required. Okay, carriers have 30 days to just acknowledge your claim and have to respond within 120 days. So you can put the carrier on notice of a claim. They don't even have to reply for 30 days. That's stressful. Carrier negligence has to be proven. That's what I mentioned earlier. You have to prove the carrier did something wrong to to cause the claim. That's on you to prove. I don't know how you prove that in many scenarios. So the carrier is at the advantage there to be able to just kind of frankly push you around and avoid having to pay and avoid having to have a claim on their liability policy. Claim payments generally do not cover the loss experienced by the shipper or the insured. That's what I mentioned earlier. If there is a claim and the carrier's liability does pay out, it's not based on the value of the goods. It's based on a schedule of tariffs based on the weight of the goods. It's really screwy. With an all-risk policy like TRG sells, or like many agencies will sell if you go out there and shop the market, the insured is required to provide proof of value and proof of loss. Pretty basic. Claims are typically paid within 30 days. Like I said earlier, if it's $10,000 or up, you can expect it to take longer than 30 days, maybe 2 months. Claim payments cover all losses under the policy limits. So the policy has a limit. We'll talk about that in a second, but you want to make sure your per loss limit on your policy is high enough. If you are not required to prove you are not required to prove carrier negligence. So that's a big difference between the carrier limit of liability. You are not required to prove that negligence. So minimizing risk while in transit.
So Travis, we had a question that maybe you can just answer now, which is, isn't it next to impossible to prove carrier liability? But just to expand on that, have we at TRG seen payouts on carrier liability through our claims process?
Yeah, and that's part of it. I mean, when you let's just speak. When you are a TRG cargo insurance client, you file the claim through us. You go through that process, and we work to settle the claim as quickly as possible with you. We might ask you to try to recoup some money from the carrier if we think that's possible. And often when we ask you to recoup that money from the carrier, from their liability coverage, we will stay CC'd in that communication. So the carrier will see that you have an annual policy in place. When they know you have an annual policy in place, there's a big, scary insurance company underwriting that policy. The insurance companies we represent and any agency represents has the wherewithal and the means to get everything out of the carrier that's practical by their liability coverage. I think that answers the question. So we do see the carriers pay out when there is a claim with our clients, and that helps reduce the claim amount on the loss history. But a big reason we have success is because the insured is working with us and the insurance company that underwrites the coverage. And those insurance companies and TRG knows how to have that conversation with the carrier as effectively as possible to increase the chance of holding them liable for as much as we can hold them liable per their liability coverage. And it's still never going to be as much as a true loss. So what are we talking about now? Minimizing risk while in transit. Some very basic ways to look at it, but we got to talk about this because some people don't think about it this way. Minimizing risk while in transit. Be proactive. So being proactive, you're on this webinar, so you are concerned. You are proactive. What you want to avoid is trading on goodwill or shipping and praying. You're saying, I place the order. It's going to arrive. If not, whatever. If that's your mentality, then the value of the shipments really aren't going to hit your bottom line if there's a full loss. You got to think before the shipment. Am I doing how does it impact my business if I incur a full loss on this shipment? So you got to be proactive, being on webinars like this, talking with your agent, and taking some of the tips we're going to talk about right now are an example of being proactive. Vet your logistics providers. This is more important than ever. I'm sorry to say it, but with the spike, there's a big spike in domestic trucking theft in the U.S. right now. There's no one single way, but in my mind, vet your logistics provider goes right in line with protecting your goods if they're being trucked around the U.S., especially in the California area. Take pictures. of the people driving the truck before the truck leaves your location. Take a picture of that driver. Look at the actual truck and see if the rivets have been replaced with nuts and bolts. That's an indication. If the rivets on the side of the truck have been replaced with nuts and bolts, that means that the truck has been adjusted so they can quickly take goods out if the goods are stolen. Look at the truck to make sure the numbers have not been scratched off. Talk to people on the phone. Talk to people on the phone to confirm details about the shipment. Those are all really basic practices that can be missed when you get busy, but it's really worth taking those extra steps. Ship in and out of ports with good infrastructure. Generally, our clients are shipping in and out of ports with good infrastructure. There are countries where the infrastructure becomes dicier, maybe to get to and from the port. A lot of times the underwriter can identify if it's a riskier area or region and be open to taking advice on to how to change your shipping practices. Maybe the trucks only go to and from the port during daylight hours, or maybe they stay on main highways. But be open to advice and look to be aware of the ports that you're shipping in and out of. Act as if you are the one paying for the mistakes. You can be under the mindset of, well, I got insurance, so whatever happens, happens. That's a bad mindset. At the end of the day, it's your loss history. It's your premium that you have to pay. So if you avoid the losses to begin with, you're going to be much happier in the office. You just have to have skin in the game too. There's almost always a deductible. Nobody wants to pay the deductible, but act as if you got skin in the game. So how do tariffs impact cargo insurance? It's 11:30, so we're getting through these slides quick enough to be done within an hour. What we just talked about is an overview of cargo insurance. And I hope I answered more questions than questions arose from what I talk. If you have any questions, hit Michael or Meredith and we'll talk through them. But in today's world, you can't talk about international shipping without addressing the tariffs. And tariffs absolutely impact cargo insurance, especially those of you that have had an annual policy in place for years and years and years, and you really haven't looked at it critically. It's important to look at the annual policy you have in place and make sure it's adjusted to account for these tariffs. And how exactly do you look at it? That's what we're going to talk about. First and foremost, you got to look at the per loss limit. Every cargo insurance coverage has a per loss limit, the most it will pay out on any one single claim. You may have set this per loss limit 5 years ago when you moved the coverage to a certain agency or a certain market and not had thought about the per loss limit since. But you got to look at what your biggest shipment for the year is. So the most value you have on one boat or one airplane or one truck at one time. You got to look at the value of the goods. You got to consider the freight for that shipment. And potentially, if you want tariffs covered, duties, taxes, and fees, or tariffs covered in the event of a claim, you also have to account for, the 25% or 40% or 10% additional wherever you fall, and apply it to that total value of the shipment and make sure the per loss limit on the policy is high enough to account for these higher tariffs that we're seeing. And if anything, have a per loss limit with plenty of breathing room. The per loss limit 80-90% of the time does not impact the premium. The per loss limit should give you enough buffer to give you peace of mind, and you should have that number highlighted, and you should be thinking about it as you have large shipments, but you don't want to be jumping around on that per loss limit. You just want to set it high enough and not, think about it, but not revisit it with every shipment. Now, we got to talk about valuation. So the first thing is the per loss limit. That's the most the policy will pay out on any one single claim. And valuation, the valuation on the policy is how the claim value is calculated. Generally speaking, the valuation on most policies is CIF plus 10%. we certainly have policies that are just simply the valuation is selling value. So these are clients that import into the US and then sell their goods. These clients might choose to have their valuation set at selling value, and that's a higher value. That's what you're selling to the end client at. You'll pay more in premium in that example, but some clients want to pay more in premium to be able to insure at their selling value. The bulk of insured clients are totally comfortable with insuring at CIF plus 10%. So with CIF 10%, in the event of a claim, the claim is not based on your selling value or your wholesale value, whatever you want to call it. The claim is based on the equation cost plus freight with a 10% uplift. So cost of the goods that you pay the supplier plus freight for the shipment with a 10% uplift. Now, it's almost comical to think about it now, but in prior years, that 10% was accepted as an uplift, a 10% uplift to account for ancillary fees, such as duties, which includes tariffs, port fees, broker fees, general claims like drayage, transload. With international shipments, there's any number of additional fees that might stack on top of the cost and the freight. But that 10% was accepted to cover import duties, broadly speaking. Guess what? 10% doesn't cut it anymore. So if you want your policy to include duties, taxes, and fees, which tariffs fall under, you need to speak with your agent to make sure your valuation in the insurance company underwriting the policy is okay with the valuation, including tariffs or duties. Let's talk about incurred duty. Incurred duty is duty paid to U.S. Customs, and that specific shipment has been entered into the country or cleared through customs. So for an insurance company to include duty in a claim, number one, the policy has to be written for the insurance company to acknowledge and say they will cover duty, which tariffs fall under duty. Number two, the specific shipment where there is a claim, the duty has to be incurred. So the goods, the money has to be paid to customs and the goods have to be cleared into the country. If you haven't paid the money to customs yet, if you haven't paid the duty yet, then it's not going to be included in the claim. I think everybody can understand that. Let's look at an example. Yeah, Michael.
I was going to jump in. There was another question in the chat. If your per loss limit is adequate for your typical shipment, but you get a one-off PO for goods that are significantly more value, do you contact and raise the per loss limit for that one-off shipment without rewriting the entire policy, or how do you handle that?
Yeah, if it's truly a one-off, then generally, they'll just bump it up for that one shipment. You'll get the details on that shipment. The insurance company will say this is covered for this amount. So that's a one-off example. If you think there's a chance you might have multiple shipments throughout the year, then just go ahead and bump it up for the year. It really, some insurance companies will charge more, and generally it's really not that much. Some insurance companies will just say, yeah, we'll increase your limit without, it depends on all the details, but don't ignore it. You know what I mean? Thank you for asking that question. These higher value shipments and these higher tariffs should have you revisiting all these details. Talk to your agent before the shipment starts. And if the shipment is already on the water, still talk to them now before there's a claim. Let's look at a claim example with these following details, these bullet points on the left. Total CIF value, $100,000. So total CIF, that means total cost of the goods and freight value, $100,000. 25% duty rate, which, is not uncommon right now. $1,000 deductible on the coverage and no enhancements that are going to adjust anything. But CIF plus 10%, we get to the calculation on the right. Total CIF value, $100,000. So cost of the goods plus freight totals $100,000. The uplift is 10%. CIF plus 10% gets you to the total CIF plus 10% value of $110,000. That's your insured value in this example, $110,000, $1,000 deductible, which is standard in the industry. You can get higher or lower, the deductible can be adjustable, but 1,000 is standard. So the policy in this example would pay out $109,000. This is an example where the insurance company is not agreeing to pay duty. Now how does that impact with that 25%? And you all know the math already, but it's good to see it written out. Again, total cost and freight, $100,000, incurred duty, $25,000, roughly, probably a little bit less because freight isn't going to be included in duty, but total loss amount, $125,000. Total amount recoverable, what the policy is going to pay out, $109,000. So in this example, you're underinsured by about $16,000. This is what I want everybody in this webinar to avoid. If you talk with your agent, if you do want duty to be covered, have the conversation with your agent, get confirmation from the insurance company that they will cover, duties, tariffs, taxes, all kind of the same thing. So confirm they will cover it in the event of a claim, and confirm your per loss limit is high enough. Two big takeaways with cargo insurance. So that's our final slide we have on cargo insurance. Just another general thought. It's been a soft cargo insurance market for a couple of years. We are now, believe it or not, in a soft, generally speaking, property insurance market, aside from maybe California and Florida and specific areas in the country. It's a soft property insurance market and absolutely a soft cargo insurance market. Soft market means insurance companies are hungry to write more risk. They're going to quote much, much more aggressively. It's a really good time to shop. Of course, I want you to come to TRG and let us take a crack at your coverage if you're not already a TRG client. But, you should generally be looking for your agent to go out there aggressively and try to find better premiums because it is a soft market. So let's talk about U.S. Customs bond a bit. This is who TRG is: cargo insurance and customs bond. We got to hit on customs bonds because there's a ton of questions and unknowns out there. How do tariffs impact your customs bond? Increased tariffs result in increased bond amounts. We don't have a slide specifically stating this, but our previous webinar with Star talked about calculating your bond size. So you can look at that previous webinar, find me on LinkedIn, and I can send you a really good outline on how to calculate your bond size. But as a basic, the equation is very simple. Take duties, taxes, and fees. So the duties, taxes, and fees you pay U.S. Customs, that includes tariffs. It includes anti-dumping and countervailing if you're subject to anti-dumping and countervailing. But take duties, taxes, and fees. It includes port fees, harbor maintenance fees, duties, taxes, and fees paid to Customs in a 12-month period. Multiply it by 10%, and the result is your bond size. So if the result is $30,000, then you go with the $50,000 bond because a $50,000 is the smallest continuous bond size Customs allows us to place. So anything less than $50,000 will generally mean you need a $50,000 bond. It goes up in $10,000 increments. Import bond sizes go up in $10,000 increments to $100,000. Then after $100,000, they go up in $100,000 increments infinitely. So that equation, duties, taxes, and fees times 10% gives you your bond amount. If you pay $8 million in duties, taxes, and fees, then you need minimum $800,000 bond, or 900 or 1000, or I'm sorry, 800,000 or 900,000 or $1 million bond. You might want to, I absolutely advise to give yourself some buffer because there's so many unknowns right now. So these tariffs are driving up duties, taxes, and fees. So you need to keep an eye on your bond because if you're stuck with an insufficient bond, you will not be able to import. Customs will not allow you to import if you have an insufficient bond on file. It's a good idea to be monitoring your sufficiency so you know ahead of time, but also keep in mind that Customs sends out insufficiency notices during the first week of every month. Just today on my LinkedIn page, if you find me on LinkedIn, I posted an example of the insufficiency letter with a breakdown of how to read that insufficiency letter. If you're getting an insufficiency letter for the first time, it can be confusing, just like anything else from customs, but it's not rocket science. So I'm hopeful that everybody in this webinar that ships enough is tracking your bond sufficiency, so you're expecting an insufficiency notice before you get it. But keep in mind, customs sends out insufficiency notices during the first week of every month. When you receive that insufficiency notice, you have 30 days to act. So it's not like, there's an incredible amount of anxiety out there because importers assume that their bond will be rendered insufficient when they get the insufficiency notice. That is not, customs can do that, but that is very, very uncommon. You have 30 days to figure out the bigger bond once you get that insufficiency notice. Work with your bond provider. Get them information they're requesting as quickly as possible. It is a process to increase the bond size, and every account's a little bit different. Countless accounts, you're able to get a bond size increased very, very, very painlessly, but don't assume it's going to go smoothly. Assume it's going to take extra time. Work with your bond provider. Give them what they're asking for, because there is an incredible demand, not only on TRG, but every other bond. There's about 4 other major bond providers out there. There's a lot of insufficient bonds right now. There's a huge workload. You do not want to get caught with an insufficient bond, so work with your bond provider. Yeah, Michael.
We had a couple of questions on that bond. First one being, would this include the recent executive orders and Section 232 and 301 and other tariffs?
Yeah, all that should be included in this calculation. Thank you for asking.
Yeah. And the next question is, why would you increase your bond amount before you actually get an insufficiency letter?
Well, yeah, okay. So generally speaking, we do not pull the trigger and increase the bond until the insufficiency letter is received, and we coincide the termination and the placement of the new bond with that letter. But in a perfect world, I want all TRG bond clients and all U.S. importers to have the underwriting and all the boxes checked even before the insufficiency letter is sent. So the requirements and everything's lined up to go smoothly once you get that letter, and then we put everything in motion to increase the bond size. Sometimes we'll increase bond sizes earlier, but that's an exception.
Mm-hmm. And I want to give you the 10-minute.
Yeah, 10-minute warning. Cool. So I'll try and fly through these in the next 10 minutes. Tariffs so these tariffs, that question, do 232, do 301, do the fentanyl, the reciprocal tariffs. I'm sure you all are rolling your eyes at me saying, how the heck are we supposed to know what's going to happen? Guess what? Everybody's in the same boat. Nobody knows what's going to happen. But if you're approaching an insufficient bond, and if you can forecast out and you're going to be insufficient, just make that painful decision on a bond size that you think will be sufficient for a full year and move on with the process. We're not going to get more clarity anytime soon. Maybe we will get more clarity as court rulings come out and the Trump administration, but I feel like, and I think many of you do, every time there's a Truth Social post about tariffs, it only raises more questions about what's going on than what it answers. So I get it. Nobody has a crystal ball. The crystal ball has been smashed. Nobody knows what's going to happen, but that does not take away your responsibility in the fact that if you don't have a sufficient bond, you won't be able to import. One of my clients said their company's kind of mantra is protect the supply chain, protect the supply chain. I'm the bond guy. I'm saying place a big bond. You don't want to be caught with an insufficient bond. Nobody knows exactly what's going to happen in the coming months, but make the decision on a bond size you think will be sufficient for a year and work with your bond provider to make sure you have a sufficient bond. Otherwise, it gets a lot more difficult, incredibly more difficult if you delay those decisions and don't work proactively with your bond provider. Okay. Here's a quick graphic on the left. You see the blue lines, which are normal entries And, the duties, taxes, and fees stay pretty consistent. In the bottom right-hand corner, we use 301 section entries as an example. Boom, 301 hits. Duties, tariffs, and fees. Duties, taxes, and fees double, trending that company to go insufficient quicker. So if you're subject to tariffs, you really got to keep an eye on your bond sufficiency and start to plan to increase as you look at it. Let's look at what we learned in the past. This is a look at 2018. That was 7 years ago. This was the first trade war. TRG, we have about 9,000 or 10,000 active bond clients. We do start pinging our clients at 80%. So some of our clients increase their bonds before the insufficiency letter is sent. But generally speaking, we wait, we get everything ready and pull the trigger once the insufficiency letter is sent. Here's a look at how we saw insufficiency notices increase during the first trade war. From January, February, March, April in 2018, it was sleepy. We saw, about 5 insufficiency notices a month. Boom, 16, 31, 18, 35, 10, 19. And those aren't huge numbers, but that's more than, 5 times what we traditionally saw. So this is an indication of the turmoil and the stress that the industry is under. Another great example of don't be the low-hanging fruit. Work with your bond provider. Get them information. Don't assume the process is going to go just without any hiccups. We're all working to get the bonds increased in as smooth of a process as possible. But you got to understand these insurance companies that underwrite the bond, they are seriously looking at this significant increase in liability that they're being asked to take on. Bond size is going from 100,000 to 3 million or 100,000 to 5 million. That's a huge swing in liability. The insurance companies are not just going to approve these larger bond sizes until they feel comfortable. So don't assume the process is going to go quickly. I mean, we're all working to get it done as quickly as possible, but we got to be on it. So that's 2018. 2019, look on the left side. Yeah.
Oh, sorry to interrupt you, but we got a question that would be good to show a past slide. I remember that CBP runs their sufficiency query differently than companies do, annual versus rolling period timeline, correct? So basically how sufficiency is calculated based on a rolling period doesn't always align with your company's budgeting for their annual budget.
I guess. I mean, that's the way TRG thinks about it, the way Customs thinks about it. It's a rolling 12-month window. That might not align with how you traditionally look at your bond sufficiency internally. But if it doesn't align, then start looking at it on a rolling 12-month window of duties, taxes, and fees paid to Customs. Customs works off of the historical data because that's the data they have. You, as the importer of record, when you place a new larger bond, the best practice is to look at your forecast of shipments for the next year, apply what you know today to the future, and then calculate a bond size that's not only appropriate for what Customs has on file, historical data, but also a bond size that will be sufficient for the next 12 months. And I know nobody knows, it's hard to predict what's going to happen, but you still got to do it. And then I really love this data, looking back at this slide, 2019 bond increases. And on the left side, there was a government shutdown in January. So February, we saw insufficiency notices spike up to 77. That 77 was the high point of TRG insufficiency notices during this, what you call the first trade war or the first phase of the trade war. Now, what month are we in now? July. June, TRG saw 100 insufficiency notices. Just yesterday for July, we saw 96 insufficiency notices. So I guess one of the takeaways I really want the industry, and I just find this super interesting, but we're seeing much more of an impact from the current trade war than this first phase of the trade war, 2018, 2019 timeframe. And this carried into 2020. But looking at these numbers drives home the turmoil and the change that, you as the importer have to absorb this. Customs is working with a huge new flow of data, and they have access to mine data better than ever. And the third party with the customs bond is the insurance company. At the end of the day, there's only about 40 or 50 insurance companies that underwrite U.S. customs bonds in the country. There's really only 4 major players as far as insurance agencies that write bonds. So the filter gets small pretty quickly. And we're all trying to work through this as quickly as possible. But, work with the insurance company, get them the information they need so you know what you have to do to place a larger bond if you get an insufficiency notice. Now, what can you do? I think I verbalized a lot of what you can do over the past hour or so. I got to give a quick plug for TRG. This is a differentiator in the industry. Number one, TRG, our general business model is to work directly with the importer of record. We do have some relationships with other insurance agents or customs brokers or freight forwarders where we work through them to deliver the bond to the importer of record. But 98% of our relationships are directly with the importer of record. And I highlight that because if you are a TRG bond client, you have access to what I'm showing here on the screen. This is a snip from our Eagle Eye Ace compliance software. This is just one of the screens that our compliance software allows you as a TRG bond client to see the data that we get from U.S. Customs in a friendly, easy to navigate interface. On this screen of Eagle Eye Ace, you see your importer compliance score. There's also an unliquidated entry score and a trade compliance score. So at a glance, if you're using the software, you can see maybe today it shows your importer score is 907. So you're in the green. It's a very good score. Maybe a week from now, you open this and the score drops to 700. That's an indication that you need to look deeper and see why your score dropped. Maybe you already know there's a snafu with a specific entry, so you have a really good idea of why the score had dropped. Or maybe you don't know, but the supporting pages behind this page of the interface can help you dig in and see what's going on. So these are TRG. There's a TRG algorithm that assigns these scores. This is not a customs generated score. This is something TRG creates for our bond clients to be able to gauge your compliance as quickly as possible, as easily as possible, based on the data we get as your bond provider. There are many different pages and data points that you can access with Eagle Eye Ace with this software. The other one the other page on Eagle Eye Ace I want to highlight is our bond sufficiency page. So if you are a TRG bond client and if you get access to Eagle Eye Ace, there is a premium to pay for Eagle Eye Ace. There's a trial period. You can do it for free, but you do pay extra for Eagle Eye Ace. If you choose to use Eagle Eye Ace, whenever you want, you can log in and see your bond capacity. You can see on this screen, this green line. In this example, the bond client is at 46.9% capacity. That red button, go to the report, allows you to dig in quicker, dig in deeper to bond sufficiency. We break it out in that rolling 12-month period that we were talking about a second ago. We break it down quarterly so you can see where you're trending. There's lots of graphs. There's lots of tables that allow not only you, I'm assuming most of these people on this webinar are really compliance oriented, but this software allows you to share it with others in your organization, like your CFO or the finance team. Very often, I think it's so important, especially with these tariffs, for the compliance people in an organization to be able to get the finance department on board. And when you can show the finance people and people in your organization stuff like these compliance scores and show sufficiency as a graphic, then you start to get people on board and understanding the complexities of compliance. And there's much more data. You can see specific entries and breakdowns on duties, taxes, and fees. But that's our software at a glance. Every time I get in front of importers, just kind of switching gears a bit. We discussed cargo insurance. We discussed bond. Now this slide, every time I get in front of importers, I try to stress these 3 free actions you can do. Number 1, Many of you are already doing this, but still many importers don't know about it, or they've just not done it yet. But pay U.S. Customs via their automated clearinghouse. Is that what it stands for? But using that QR code on the right, it'll link you to a customs page that allows you to set up a bank account where customs can pull the money from you directly. Many importers are still paying customs through the customs broker. So the customs broker tells the importer how much the duty is. You pay the customs broker gets the money to customs. It's not the end of the world, but why not have your money flow directly to customs? It really, really reduces the chance for error or fraud, frankly. So number one, set up ACH with U.S. Customs. Number two, file vessel manifest confidentiality. This is a letter you send electronically to Customs once every 2 years requesting Customs keep your vessel manifest, your details on your shipments confidential. If you don't request they keep it confidential, then they leave it out there as public information for websites like Import Genius or, what are the other ones? There's countless companies that mine that data and make it available and then sell it. But it does not benefit you at all to have your data out there. So file vessel manifest confidentiality. It takes a second. You do it once every 2 years, and then your personal company data is less available. Number three, I always encourage companies that ship internationally to join ICPA, International Compliance Professional Association. If you go to that link and join as an individual, they'll give you the first year for free. So you can join as an individual. If you make sure you join as an individual, that first year is for free. Then you can decide how valuable it was. But it opens the door to be able to bounce ideas and questions off countless other companies and individuals within companies that have been through and are going through the same experience as you are. So it's a great networking opportunity to help you navigate international trade. All three of those are free. You just have to put in the time to do them. And that's kind of how I like to end up my talks. And I think we're right at the hour mark. That's me. I'm Travis Smith. And there's some details about TRG, how to connect with us. But, if you have any questions, give me a call, 406-922-6526, or find me on LinkedIn. Michael, I think that's all we got.
There we go. Thank you, everyone, for joining us. The code was posted in the chat. It is also available on your screen. You will also need to include the dashes when you are saving this code. If you're entering this for NCBFA credit, please double check whether you're entering the code at the link for the live webinar or on demand. That link was also posted in the chat. The codes and links are different for the live and on-demand versions, so be alert to that. Again, I want to say thank you to Travis and Meredith and the whole TRG family for joining us on today's session. I think there might be a couple of questions that we glossed over. If you don't mind, I'll try and find them and read them to you. They're higher up now that everybody's talking. We talked about the prelimit. On the subject of improper packaging, going back to the cargo insurance, if the packing is intact but the goods are damaged, would that be excluded? So the packing.
Generally speaking, that's covered. I'm never going to definitively say any scenario is covered because every detail has their own detail. But that even if the packaging is not intact and the packaging wasn't perfect, the insured should be taking reasonable care. That scenario would be covered. Okay. If it's good packaging and the goods are damaged, it's generally going to be covered.
Another question, and I didn't know the answer to this one at all. What is an on-deck bill of lading versus an under-deck bill of lading? I
don't know. That's something I've read a million times in webinars. And I think I don't know if I should answer this because I'm not sure if my answer is right, but whoever asked that, we can connect and I can answer that more directly. But I think if you specifically say, like I ran into one company that ships sailboats, huge sailboats, and they just really only, the best way to ship them is on, they can get wet. They're a sailboat, just the hull. They say ship it on top of the boat. If you know your goods are going to be on top of the boat, then talk to your insurance provider about that. It's like break bulk. If you know you're shipping break bulk, tell your insurance provider. That's one of the questions on our application. To me, break bulk and on deck versus under deck is kind of aligns. But those type of shipping methods that aren't in a traditional 40-foot or high cube or 20-foot container, just make it known to your insurance provider. Does that make sense? You know?
Yeah.
Yeah, Travis.
Meredith,
Yeah, I mean, well, just to confirm, that is what it is on deck is that the goods are stored on the deck of the ship. And the big thing there is exactly what you're saying. If your insurance specifically states that the goods must be stored below deck and then they are stored on deck, that would not be covered. So it's kind of a little bit of like a special case. I think the example of sailboats was a good one, something that has to be stored on deck versus, below deck. But like you're saying, the best course of action is always just open communication with your agency.
Yep. There was one more question on here that I saw. You mentioned that there were 4 underwriters for bonds.
Yeah.
Do you happen to know who they are?
Yeah, I know. This is a slide we often include, but again, this webinar, we tried to gear it more towards insurance, but right now the bond is just taking over. And if you're a bond provider that, I'm talking about agencies that originate bonds. I'm not talking about insurance companies that underwrite bonds, but insurance agencies that originate the bond. They file the bond and the insurance company underwrites the bond. TRG, we represent Hanover, Hudson, and Old Republic as our insurance companies. They underwrite the bond, we file the bond. As far as agencies that actually file the bond, there's Avalon, CA Shea, Roanoke, and TRG. Those are kind of the big 4. Now, I'm sure there's somebody else out there that I'm forgetting, but if you're on this webinar, there's a 99% chance, 99.9% chance, you might be paying your customs broker or freight forwarder for the bond, or you might be paying your general insurance agent, but that customs broker, freight forwarder, or general insurance agent doesn't have the means to originate the bond, to write the bond. So it's Avalon, CA Shea, Roanoke, or TRG. Avalon, CA Shea, Roanoke, they take up like 95% of the marketplace. They're kind of the big dogs. And TRG, we got, 5 or 10% of the marketplace. But that's the breakdown, and that's the flow. Avalon and Roanoke, their primary business model, if I'm to understand them correctly, is to sell bonds through customs brokers and freight forwarders. And CA Shea's primary business model is to have relationships with a big group of insurance companies. So if a general insurance agent gets a request for an import bond, that general insurance agent is probably going to say, oh, yeah, I'll help you with that import bond. Then they're going to get off the phone and say, what the heck's an import bond? Because they just don't do them all the time. They're going to call the insurance company that underwrites that company's general line of insurance. That insurance company probably has a relationship with CA Shea, so they'll filter that insurance agent to talk to CA Shea. So CA Shea's business model is to write through general insurance agents.
Excellent.
And we'll kind of do it anyway, but generally we work directly with the importer of record.
Another one, Travis, we didn't fully touch on with just sufficiency letters. I thought this might be important is, does the letter from CBP tell you how much your bond needs to be increased to?
So again, I point you to my LinkedIn page because just today I posted that breakdown that Meredith, you created of the sufficiency letter that I love. And reach out to me on LinkedIn or whatever, give me a call if you want to talk about it more specifically. But that insufficiency letter, it's going to tell you the minimum bond size customs will accept. In 99% of the time, it's just the next bond size up. So if you have a 50K, they're going to say the minimum bond size you can place that we will, I'm not sure exactly what the wording is, but the minimum bond size you can place that we will accept is a $60,000 bond. Now, almost every time, if you just go off that in this example, $60,000 bond, you're going to end up insufficient again in 3 or 5 or 6 months. So Meredith, the insufficiency letter, and you know this, Meredith, but the answer is the insufficiency letter will tell you the minimum bond size customs will accept, but the best practice is for you as the importer of record to forecast out and calculate what bond size will be sufficient for a full 12 months and then place that bond size. and it's almost always going to be larger than what they say in the insufficiency letter. But unless we absolutely see companies getting stuck in that cycle. They just keep placing the next bond size up. And that's a bad cycle to be in. You end up spending more time, more money, and often collateral becomes part of a requirement.
Well, excellent. Yeah. I think that concludes our webinar today. Thank you for everyone that stuck around. Thank you, Travis and Meredith. Any final thoughts?
No, good luck.
All right.
I did drop links if you want to connect with Travis or myself or with TRG on LinkedIn. So you can find those in the chat as well.
Yep. And again, we will send out an email with the recording and links to all his information. So everybody that registered will get that email. You'll have all that to go off of. And obviously reach out to Travis and Meredith directly. They will definitely be able to help you guys out. Thank you again, everyone. We'll see you next month for EEIs.
Yeah, thanks, Michael. Thanks.